very special conversation now with Sandeep Tandan, founder and CIO of Quant Mutual Fund, who is joining us today. And of course, we will be talking about where the market direction is, even as markets are on an upward trend, but in a slow and steady pace instead of a big move. You're seeing the Nifty just about staying above the 26,000 mark and struggling to do so from the last several sessions. What really is holding back the bulls is the key question. Is it the uncertainty over the trade deal, or is there more? It's also a great day to speak to Sandeep Tandan about what SEBI has proposed in terms of mutual fund charges. And in fact, before we get to Sandeep, let's just take a look at how some of those AMCs are actually doing in trade after those proposals have come out. It's not been taken too well by the street. HDFC AMC at 4% down right now, and you're seeing UTI AMC, a whole host of them actually, 361 WAM, Nuvama. Anyone in the business of selling mutual funds to investors is going to see a bit of a pain point, and Nippon Life is among those companies. Nuvama also seeing about a 3% dip. Now, the question really is that on balance, is this going to be a pain, or will this increase volumes and therefore make up for any losses? Sandeep Tandan with us. Sandeep, can you hear me?
Yeah.
All right, great. Always a pleasure to speak with you, of course. Let me start with the market outlook first before I get to SEBI proposal, etc. What really is holding the bears back? That's the question I placed before the audience in the setup to this conversation, because we've been hovering around that 26,000 mark. So much has happened in terms of signaling from the Reserve Bank of India, GST reform, consumption boost over festive, but somehow we're not able to break out. Is it the trade deal that's concerning the street, or is it FIIs being hesitant?
So I will answer this in a more from a behavior perspective. If you really look at how the gold has rallied, the wealth effect, the people are able to spend more money because your background wealth effect is there. Now, last 1 year, the wealth effect is negative for the mutual fund investors or the equity investor in general. Okay, and also coming from a background that from 2020 till 2024, we have seen extraordinary returns. So when you're talking about extraordinary relative basis, industry is unable to deliver return, or the index is unable to deliver. So it's obviously when you are not able to make money, okay, so obviously the mindset is slightly more negative and you are more concerned about it. But look at the positive side, that the market has absorbed many negative news. Worst ever selling we have seen. Okay, we have seen the worst ever tariff related challenges from the US market, worst ever geopolitical stress we have seen. The market has responded quite well. It absorbed the shock, and I think market is now ready for next round of takeoff. This is the small correction and consolidation phase we are going through. But the probability, if you ask me, whether upside is much more than the downside, then my answer is yes. We expect market to recover. Maybe after a small halt, then market should rally, and that's a perfect background is there, both from a behavior perspective, short position perspective, even the earnings perspective. Even IT earnings were far superior than the expectation.
Right, right. And in fact, I think earnings expectations or earnings performance is going to be a big driver. Now, Sandeep, what's the timeline like? From what you're describing, clearly now is a good time to enter and take positions because another rally or an up move is expected. What is the timeline? Are you seeing an improvement? Will we at least end this year, a calendar year, on a 26,000, or is it going to be a 4 to 6 month wait?
So beginning of this summer 2082, we have broken into 4 quarters. I said the first quarter looks definitely attractive, which means effective 21st October till January 20th definitely looks like a very constructive background. Instead of talking about 1 year or 5 year perspective, I will go by quarter and quarter. So at least from next 1 quarter, the outlook is definitely more constructive for Indian equities.
Okay. Sandeep, outlook is more constructive, over the next 1 or 2 quarters is what you're saying. If you have to look at valuations and the cycle we are in right now, which are the pockets of growth that you're seeing? Because GST reforms absolutely in place, a boost to consumption is what everyone is talking about. But when do you see that flip happening where valuations will be favorable, returns will be favorable, and a best time to invest then?
We always say India in a structured bull run, something has change for India from long-term perspective, which means the P multiple or the valuation multiple on any factor you look at will remain elevated for a longer period of time. If somebody is expecting the market will, this valuation will correct decisively, that will be buying opportunity. I don't think he or she will get ever that opportunity. That's something which has, I always talk about from a perception analytics, something has changed for India. That's the first point. Second point, what we have to look at the how the liquidity cycle is changing from a near-term and medium-term perspective and how the momentum on the earnings. So we are very clear on that front that sentiments are have reached a rock bottom sort of thing. We are seeing signs of exhaustion there by selling. We are seeing signs of exhaustion in the USD INR as a pair. We are seeing signs of exhaustion in terms of short buildup, which is there. So multiple. One way of looking is that when we say that what sort of upside you look at, the first thing I'm looking at my downside is getting capped. The exhaustion signs are very visible, which mean the upside could be much more than the downside. As far earnings momentum is concerned, we have been saying that we expect maybe by end of September quarter earnings, things will start looking up. And so far, results have not disappointed. It's going in that direction. So I think I would like to remain a constructive approach for Indian equity from the current level. And that's the reason we are largely 96-98% invested in most of our seats.
And Sandeep, in terms of individual sectors as well, you have been absolutely positive when it comes to the pharma pack. Still, the move is pretty much sideways. Now, if you're looking at pharmaceutical as a sector currently as well, which space within pharmaceuticals is your investment bet?
See, from the current level, the biggest safest bet is the US generic. Okay. And even Trump has clarified, the administration has clarified there's no duty or anything which they are looking on the generic side. And because generic is something which US is also dependent on India. So that's the one area where I'm constructive. Apart from, then we are more inclined towards domestic centric economy stocks. So think whether you talk about a consumption stock or large infra stocks or large hospitality space. So in general, I'm more construct on the domestic centric, except the pharma, which is the only export centric. And even you look at some of the textile names, they have corrected significantly. So some of the shrimp manufacturer, all these names, because in the sentiments which was not in our favor, these stocks have corrected. So anything which looks like a buying opportunity, provided you believe the deal will happen, we believe deal will certainly happen. It's a question of time because in a larger interest, even US needs deal to be get close. So some point in time it will happen, whether it will take 1 month's time more, but it is something which is certain. Timeline is very difficult to predict, but we expect maybe by end of November it should settle down.
Okay. Sandeep, I want to talk a bit about the BFSI space. And today, because the focus is on SEBI's proposals on total expense ratio, charges, etc., with the idea of rationalizing it for investors. First of all, your take, a bit of a debate going on whether this is good, whether this is bad, what it will do for the industry. So let me start from there.
So I think I have not read line by line, broadly have gone through it. I think such proposal will come on time to time, and I think the regulator intent is very clear how you can enhance the investor return. That is their endeavor. So we are absolutely fine with that. But the only thing which we like to add, so far regulator has only focused on the tier or the expense ratio of the AMC, which where we expect the regulator should also look at the cost structures of the intermediaries. There's no regulation which actually restrict their numbers also. Like we are talking about that asset management business have grown, so your expense ratio along with your AUM should come down, which is fair. But this is also should be applicable to the market intermediary, people who provide support to the mutual fund industry. Their expense also should be brought down significantly. They have not been corrected at all. That is one of the pain point for mutual fund industry, where the intermediary cost structure, there is no control, where regulator is only bringing down the cost structures of the or the expense ratio of the AMC side. I think some amount of rationalization is required there also. Then only we can bring down these cost structure in an effective manner.
In terms of the capital market as a segment or a pocket of investment, of course, you're seeing some reaction today. So now I've asked you first from a policy point of view, and of course, we agree that lesser costs, more investors, some rationalization. But from the point of an investment bucket of the capital market play, beyond AMCs as well, do you think the best is behind us and that boom is behind us, or is there more to come?
See, maybe from a multiple perspective, you can say maybe it has peaked out from a multiple perspective, but not from a multiple perspective. Earning momentum will continue because industry is growing, economy is growing. When we talk about that, the breadth and the depth of the capital market, which is rising, and obviously AMCs and the life insurance companies and the wealth management companies are by default beneficiary of this move. So we remain constructive in that sense. So earning momentum, I don't see a challenge. The challenge is about whether we think whether this leads to some amount of capping in the multiple. So multiple expectation has to be brought down, or they may can correct from the current level what we have seen. So that could be the only worry which I see, not from the earning perspective.
Okay, so earnings perspective, you're not seeing a worry. Does anything change if you have to look at a SIF versus a SIP right now with all of these moves? What happens? Because I know SIF is a pretty new product right now. Where do you, I mean, if someone has to allocate money through a SIP and SIF right now, Sandeep, what would you tell them? I have 100 rupees. How much should be allocated to a SIF? How much should be allocated to a SIP? Because it's not tried and tested to that extent yet.
See, first of all, you have to understand that SIF, which SEBI is brought very recently, is also a very unique product. It actually brings some amount of conservatism in your approach. So the way we are advising our investor, or whenever we have given interview, we always talk about that. You should look mutual fund schemes as well as the SIF strategies in tandem. As a combination, you should look for opportunity because it actually reduces your overall volatility. And if I'm talking about combined portfolio, it brings down your vols, it gives you better diversification, and it also give you additional source of alpha by shorting. Okay, so it's a combined approach is a better option as far as SIP is concerned, or the investment on regular basis. You can do in a mutual fund also, you can do in a SIF also. So I think it's up to a very individual investor what sort of investment horizon and what risk appetite he or she has. Based on that, but somebody asked me very simple thing, what should be my ideal mix? I will say next 5 years you should have 50% mutual fund and 50% SIP in your portfolio. That will give you a very balanced portfolio.
Okay. I just want to talk about a few other buckets which look interesting. One is, of course, BFSI and also metals. Now, metals, Sandeep, I want your view from the perspective of what's happening with the trade deal. While we're still waiting for the US-India trade deal, the US-China talks have taken center stage, and we don't quite know what will come out of it, but there seems to be some framework of an agreement. Do you see that metals rally just being at its, at its start at this point?
I don't think metal has been rallying for a while along with precious metal. I think globally base metal prices have also moved up. So I think it's in a tandem it has worked very well, and now we have to see whether precious metal has peaked out, and which we believe it has peaked out. It can connect 20% odd from the peak of the levels whatever we have seen, which can also lead to some amount of softening in the sentiments at least. Okay, if not the exact trend. But what is very important to understand out here in the metal is not just a domestic phenomenon. It has a lot of currency linkages. It has a lot of global perspective. So you have to be very clear when you trade in the metal stock. If you have ability to track these data points more closely and you understand these dynamics, then only one should invest, because this is a relatively more complex and has lot many global inputs.
Just talking about the trade deal with India, Trump, who's speaking right now, and you're seeing those live visuals on the right-hand side of your screen, he's speaking in South Korea, has just said, I'm going to do a trade deal with India, and I have great respect from Prime Minister Modi. Just, a follow-up on Sandeep, this trade deal going back and forth, back and forth. Is it top of mind for markets, or is it now, if it comes in, a big positive, but if there is a delay, we're still, we have our own jig going on?
So I think it's not on the top of the mind, but definitely they're in the subconscious of most of the market participants, because something which can even, it will act as a catalyst. Let me put this way, a lot of people have written off the trade deal, but I think as one point I said in the beginning, it has to happen, because Trump is always a deal maker. He's not a deal breaker. He's a business guy. And appropriate time he will do it. Might do it his own terms and conditions. That's the reason we are seeing the delay. But it will definitely act as a catalyst as and when happen, and that catalyst should be definitely will be capitalized by a lot many institutional investors, because a lot many institutional investors like to see certainty rather than preempting that. So maybe the worry which you talked about, the institutional money which can come, maybe the post that deal, FI inflow can also increase because this sort of deal will also support the rupee appreciation. That will also give them some amount of stability or calmness in the currency market, which will attract the FDIs or FPI both.
Yeah, this is going to be interesting because you're already seeing comments coming in from Trump where he's saying he's going to do a trade deal with India and he has high respect for Prime Minister Modi, as Tamanna was mentioning as well. But, one aspect, Sandeep, I want to talk to you about is what is your view with regards to PSUs? Because you've been way ahead of it. Last year, you mentioned you were pretty much positive. A whole host of PSUs that report numbers in today's day of trade as well, from a HPCL, BHEL. How are you looking at this space? What would you advise investors to do?
So we have been very constructive on PSU for a while. If I write from 2000, September 2021, we have been talking about this is the decade belongs to them because we are now entering into a structured bull run in the value as a thesis. And you can see the best example globally is the Japan is a value market, and you see Japan is making all-time high on daily basis. Okay, so this is a very classic example where a lot of disbelief was there for Japan, and so is the case with India in the value side, and so is the case with the PSU. So I think one have to only keep in mind in an extreme risk of environment, PSU will suffer because they are largely high beta names, and hence the impact is more meaningful. But what is very important, what we like about PSU, valuations are very attractive, a very fair price you get. They're very liquid in nature. Our biggest concern in our market is that the impact cost has risen sharply in last 12 to 15 months and is not coming off now. And hence, liquidity of the portfolio is very vital for us. So we always talk about the risk of period is all about liquidity, safety, and then returns. So PSU gives you fair value on the valuation perspective. You get these are liquids are very, very liquid names, and it gives you a psychological comfort. They're relatively under-owned. So I think what is important, if you think it's a risk on rally, which we believe, then PSU will outperform. In a risk of thing, they will underperform.
That's with PSUs. How are you looking at BFSI? Tamanna did speak to you about the capital market companies. Now, if you have to look at insurance, if you have to look at NBFCs and banks, within the three buckets, where would you put your bets?
So as compared to private bank, which has been the darling of the market for last many years, in last few months, we have built a very sizable exposure in the NBFC space. So we like NBFC space better than private sector bank. Okay. And obviously in banks, we still like PSU over private sector bank. That's a no-brainer trade. And second thing important is also even the insurance company we like. I think they are in the value territory. They are in the neglected zone. A good amount of under ownership exists. People are tired with this name for a while. But given the strength in the economy and the capital market, we always say that insurance is a sunrise industry, and some of the challenges the industry has seen very recently last money on the taxation related challenges. We as a house, Quant is very bullish on this space from a longer term perspective. So it will be a slow and steady move. But don't expect any decisive move coming in these names, but it will give you a lot of strength to your portfolio. Good amount of safety is there, and these are also largely liquid names.
Okay, Sandeep, another big focus right now is what's happening in the primary market. And sometimes I think there's more action in the primary market than what's happening in the secondary markets or the cash markets. And a topic of discussion right now is valuations of a particular company that wants to listen. I'm not asking you to comment on that company or those valuations if you're not comfortable, but just to give us a sense of this gauge that investors need to look at. It seems like this is a time when a lot of companies who have been waiting on the sidelines want to come out and cash out. Investors and early investors, angel investors want to come in and cash out. What should you look out for? And is this a concern?
For us, as a relatively conservative house, we think this is the biggest concern we have. And everybody, even the best of the brain in this country, are getting carried away. It's not about people are blaming the bankers or the companies. The money managers themselves are participating. Some, like one of the promoter recently said, if somebody is willing to pay, the money manager, the fund managers are willing to pay me 200 or 250 multiple, I will accept it. It's a demand supply situation. So if demand is so skewed in their favor, it makes a lot of sense for them to exit. It is the maturity of people now, because my worry is that lot many young people have come who have not seen these cycles, and they are all very, very excited about it. And this is the way human psyche is all about, when you see M2M game coming and everybody is making money, that sort of some amount of hype is getting built in the market. And that's my biggest worry, because these are A, very expensive, B, when whatever reason sometimes the stock start correcting, there is no exit in these names, absolutely illiquid names. You look at the last 1 year, if I'm not wrong, 60% stocks are trading below the IPO price. So those are the concern which we have. Yes, short term, everybody is very happy because of illiquidity reason. The float is not there. It's easy to pull up these names. Those are the phenomena which is going in the market. And our worry is there. We generally tend to avoid all these names. As a house, we rarely invest in some of these expensive names.
No, so I have a counter to that. The other side of that conversation is that there are some new age companies that you cannot look at in terms of a conventional valuation metric. Their TAM, or the total addressable market, is something that you can't envision right now. And that is what the valuations are talking about. Don't look at it like you would look at an old economy company. That's the argument. What would be the counter?
I will give you a very fair answer. Okay, I will straight away compare how these companies are valued in the US market, which is a very mature market. If US is not willing to pay these companies these sort of absurd valuation, then why should I pay in India? Okay, and look at some of the companies from Korea got listed. They are saying they are not getting that multiple in their own country. It looks like some of these companies will now list in India because India is paying the premium, and hence people will come. There's a joke people talk about, let MNC company make India as a headquarter and subsidiary in Korea or other countries. That's the way people are talking about. So it is a stupidity on a part of our industry that we are giving these absurd valuation, and then we'll blame at later stage, oh, flow was very, very large, we have to deploy this money. So our benchmark is very, US does not give these sort of valuation, and that's a more mature and evolved market. Okay, so I will give a comparison out there rather than just looking Indian valuation in isolation.
Okay. So, Indian valuation should be looked at in isolation. But so, Sandeep, clearly, with these kind of valuations which are coming in for new age companies, would you tell investors not to really invest at IPO stage? Look at them post listing, and that's when the retail participant should enter.
I think we as a house, we are not in the business of advising people what they have to do. Okay. What they have to understand is they have to assess their own risk appetite, their own investment horizon, and their own experience with these names. So people do have to recollect what happened in 2000, how you reacted, how you managed 2008 crisis, how you managed 2018 peak cycle, and how you'll manage something like this. So if you have managed those cycles very well, please go ahead and invest up substantial money because you are smart enough to exit at the right time. If you are not able to manage those cycle well, then one has to be cautious. That's the only piece of advice I would like to give.